Welcome to XM.com for the Daily Market Comment by Mario Sotikiriakos. I'm Christina Marujos. Another round of hawkish rhetoric from Fed officials and a flight to safety resulting from China's virus outbreaks propelled the world's reserve currency higher as the new week kicked off. The Fed's daily investor said that the pace of rate increases might be dialed down next month, yet stressed this won't be the end of the tightening cycle, echoing the higher for longer theme. By every indication, the Fed intends to raise rates to around 5% and keep them there until inflation rolls over, a narrative that market pricing is exactly in line with. With rate differentials widening back in the dollar's favor, the main casualty was the Japanese yen, which continues to suffer from a severe case of central bank divergence. The Bank of Japan has not adjusted its yield ceiling strategy yet, so dollar-yen has turned into a pure play for Fed bets, having a 90% correlation with 10-year Treasury yields this month. That said, there are some early signs this dynamic might change. Inflation in Japan has started to fire up and broaden out. The government has unveiled a $200 billion stimulus package that includes incentives for companies to boost wages, and the Bank of Japan chief has already opened the door for loosening yield curve control. The forward-looking Tokyo inflation data on Friday will be crucial in shaping market expectations ahead of next month's Bank of Japan decision. Oil prices experienced heavy volatility, falling to their lowest levels of the year before coming back swinging, as traders sorted through some conflicting news reports. Overall, it's tough to draw any concrete conclusions about oil prices at this stage, as the demand outlook is deteriorating rapidly, but supply remains constrained, negating some of the selling pressure. Meanwhile, U.S. stock markets took a step back, pressured by rising yields and some caution around China. Trading was thin, with volume running far below normal levels, which suggests investors are winding down and taking some chips off the table ahead of the Thanksgiving holiday on Thursday, worried that the absence of liquidity might amplify volatility. Tesla spearheaded the retreat, losing almost 7% to hit its lowest levels in 2 years. Looking ahead, the Reserve Bank of New Zealand will announce its rate decision at 1 o'clock GMT on Wednesday. Market pricing is leaning towards a 75 basis points rate hike, supported by signs that inflationary pressures are becoming entrenched. That could boost the QE temporarily. If it is a 50 basis points hike move instead, it will likely be accompanied by hawkish commentary, which could help limit any losses in the currency. This was a Daily Market Comment here at XM.com.